I think the U.S. risk assets will be doing better in the short and medium term because the debt ceiling looks no longer to be an obstacle, but that they were, if you follow the global cycle, on their way to being interesting assets this year. I think that the shift we've seen, the sector rotation into technology shares, consumer discretionary shares, and communication shares will be followed by the rest of the U.S. stock market, and that the global economy actually looks to be bottoming rather than heading into recession, which means projections for annual growth going sideways rather than going down, and it will mean that earnings expectations, which right now are entirely flat, with slightly negative earnings growth in the States and in Europe, will actually have to be revised upward. And this will happen over the next several months, and it is actually quite supportive for risk assets, which are trading in general around the world at very steep discounts to standard valuations on the normal metrics that you would be looking at compared to the last 5 years.
John, we may not be done with the Fed, right? There's still some chatter as to whether we get another quarter point in the June meeting. Here in the UK, the Bank of England certainly isn't done, and the ECB is still saber-rattling somewhat. To what extent can further interest rate increases upset that Goldilocks version of the world from here on in?
I don't know if it's Goldilocks, but I do think
pretty good to me.
Well,
re-acceleration of earnings growth, markets better.
Markets better. I'd say inflation appears to be yesterday's phenomena, and that the peak in inflation probably was after 2 years after the spike in broad money supply growth that we had in Q3 of 2020, so it was Q3 of last year. And that essentially inflation, which has dropped quite a bit over the last couple of months, it's been a couple of hundred basis points, it's come down, the headline CPI, will continue to subside, and it's probably taking a lot of pressure off the Fed in particular, where they already kind of are discussing whether or not they're going to pause. And I think you're correct that the Bank of England does have more to go. The markets do see about another 100 basis points there. And Europe is, well, we'll see what Madame Lagarde and her co-workers decide for us all. But essentially, it looks as if not only is the global cycle bottoming, but the big bugbear for everyone, which has been accelerating consumer prices, looks to be those look to be heading south. So it's really an interesting opportunity, I think, for risk assets. There's nothing wrong with bonds, according to our research. It's just uninteresting to make the money that you'll get from a 50% drop, a 50 basis point drop in interest rates compared to the 30% undervaluation of the UK equity market, or 20 for some of the major. It's been undervalued
for a very long time, though, by those measures.
Yes, that's true, and it does have the least of the expectations for earnings growth of the major markets. But the UK does have one of the more precarious economic situations compared to the rest, and that shows in the discounts.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.